Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about RTX CORP quarterly report. RTX Corporation offers a diverse range of businesses and services across three segments: Collins Aerospace, Pratt & Whitney, and Raytheon. The company's services include aerospace and defense products for commercial airlines and military aircraft manufacturers, aftermarket service solutions for civil and military aircraft engines for commercial, military, business jet, and general aviation customers military and commercial auxiliary power units defensive and offensive threat detection, tracking, and mitigation capabilities for government and commercial customers information management, services spare parts, overhaul and repair, engineering and technical support, training and fleet management solutions, and asset and information management services. These services cater to various industries including aerospace, defense, military, government, and commercial sectors. The significant increase in RTX Corporation's stock price over the past year can be attributed to several key factors. The company's strong third quarter 2025 earnings report, which exceeded analyst expectations with revenue of $22.48 billion and adjusted earnings per share of $1.70, was a major contributor to the surge. Additionally, RTX raised its full-year guidance, further boosting investor confidence. The company's record-breaking contract wins, including $37 billion in new contracts during Q3 2025, also played a significant role. This demonstrates strong global demand for RTX's products and services, supporting long-term growth prospects. Furthermore, strategic advancements in defense technology, such as the delivery of an upgraded TP-2 radar to the U.S. Missile Defense Agency, have fueled investor confidence. Analyst upgrades, including Benchmark's upgrade from hold to buy, have also contributed to the stock price increase. Overall, these factors have combined to drive RTX Corporation's stock price up by 37.44% over the past year. The primary drivers of revenue growth or decline for the company can be summarized as follows. Revenue growth drivers. The company's revenue has grown primarily due to an increase in net product sales at Collins, $1.1 billion, Pratt & Whitney, $1 billion, and Raytheon, $0.7 billion. Additionally, net services sales have increased by $2.4 billion, driven by higher commercial aerospace aftermarket sales, commercial OEM sales, and military sales. Organic growth has also contributed to the revenue increase. Revenue decline drivers. On the other hand, the company's revenue has declined due to the sale of its actuation and flight control business, minus $263 million, and a decrease in eliminations and other sales, $0.2 billion. Overall, the company's revenue growth is driven by external product and service sales increases, while revenue decline is primarily attributed to the sale of a business unit and a decrease in eliminations and other sales. Net income and profit margins. A year of growth, the financial performance of a company has shown significant improvement in net income and profit margins over the past year. Net income increased from $3,453 million in 2024 to $5,356 million in 2025, with notable gains in both quarterly and 9-month periods. The quarter ended September 30, 2025 saw a net income of $1,918 million, up from $1,472 million in 2024, while the 9 months ended September 30, 2025 reported a net income of $5,110 million, an increase from $3,292 million in 2024. Profit margins also showed improvement, with operating profit margin rising to 11.2% in the quarter ended September 30, 2025, up from 10.1% in 2024. The 9 months ended September 30, 2025, saw an operating profit margin of 10.4%, a significant increase from 7.3% in 2024. Net income margin also improved, reaching 8.9% in the quarter ended September 30, 2025, up from 7.7% in 2024. Despite these positive trends, there are some factors that may have contributed to the improvement in net income and profit margins. However, no specific reasons are provided for this increase. Additionally, net EAC adjustments had a negative impact on operating results, resulting in a decrease of $163 million in total net sales year-to-date. The Raytheon contract termination also led to a $0.6 billion charge related to the estimated impact of this termination. The company is indeed generating positive operating cash flow, as evident from its consistent performance over the past 2 years. The net cash flows provided by operating activities have increased significantly, with a notable jump of $1 billion in 2025 due to factoring agreements. This upward trend indicates a strong financial position for the company, allowing it to generate substantial cash from its core operations. The company's debt level has undergone significant changes. The total principal long-term debt decreased from $41,146 to $38,919, while the total debt decreased by $2.202 billion. Additionally, the company repaid $2.25 billion in long-term debt. This reduction in debt is reflected in a decrease of interest expenses, with net interest expense decreasing by $47 million for the quarter ended September 30, 2025 compared to the same period in 2024. Overall, both the company's debt level and interest expenses have decreased significantly. The financial performance of the company's segments and regions varied significantly. Collins Aerospace was a standout performer, with net sales reaching $7,621 million and an increase in capital expenditures and depreciation and amortization. In contrast, Raytheon performed poorly, with a decrease in total net sales by -$659 million and -$870 million for Q3 and $9 million respectively. Pratt & Whitney's performance was moderate, with net sales of $8,423 million, but a 2% decrease in capital expenditures. Regionally, Europe saw growth in the unbranded segment, plus 23% in 2025, while Asia performed poorly for both Pratt & Whitney, -12%, and Raytheon, -14%. The Americas region also showed improvement, with Pratt & Whitney and Raytheon performing well, +15% and +13% respectively. Management's outlook on company strategy. The company has a strong hedging strategy in place to manage foreign exchange risks, page 16. Despite potential disruptions from audits, investigations, or disputes, page 20, the financial impact of the powder metal issue is not expected to be significant for other engine models, page 21. A strong backlog of $251 billion as of September 30, 2025, provides a solid foundation for future growth, pages 49 and 53. Management is confident in its strategy to reduce costs and drive growth through initiatives such as cost reduction, restructuring, digital transformation, and operational improvements, page 59. The company expects to continue having adequate access to funds, with a positive outlook for future sales, earnings, and cash flow, page 56. However, potential sanctions from China and regional instability in Israel and the Middle East may impact operations, pages 41 and 49. For acquisitions and divestitures overview, RTX has made significant acquisitions, including the integration of Rockwell Collins and the Raytheon business segment. These moves have expanded RTX's capabilities and presence in the industry. On the divestiture side, RTX has terminated a fixed-price development contract with a foreign customer, resulting in a $0.6 billion charge. Additionally, the company has sold its Collins actuation and flight control business, as well as its CIS business, to focus on core operations. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In the past 2 years, it has paid out significant amounts in dividends, with $2.66 million in 2025 and $2.415 million in 2024. Additionally, the company has bought back shares worth -$50 million in 2025 and -$394 million in 2024. These actions demonstrate a commitment to rewarding shareholders through both cash distributions and capital reduction. Concerns about inventory buildup and supply chain disruption are evident in the company's financial summary. The data reveals that inventory levels have increased significantly, from $12,768 million to $13,806 million, indicating a potential buildup of unsold goods. Furthermore, the defense backlog has also risen by $9 billion, suggesting a strain on the company's production and delivery capabilities. Supply chain disruptions are another major concern, with global trade environment dynamics and macroeconomic conditions causing delays and increased costs. Tariffs, counter-tariffs, economic sanctions, and export controls may further impact the company's business operations. Regional instability in key regions such as China, Israel, and the Middle East also pose a risk to the company's supply chain. Uncertainty around suppliers or inventory management is also present, with an increase in accounts payable and accrued liabilities driven by collaborator payables. This suggests potential issues with managing suppliers or inventory, which could exacerbate existing concerns about inventory buildup and supply chain disruption. That concludes the financial summary for RTX CORP. Feel free to comment below, and I will be happy to answer them when possible.